It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today we're going to talk about a really fun subject, and that one's called taxes. And I think it's time we need to talk about that. I think we need to talk about it very seriously in terms of what's going to happen, how it's going to affect us, how is it going to affect your retirement, how much money you'll have to live on, how much you can even put away to earn for retirement if you're still doing that, of course. How are taxes going to impact us? How are they impacting us now, and how are they going to impact us in the future? So I'm going to take a subject most people don't like to talk about that much, frankly find pretty boring in most cases. I'm going to try to make it informative, interesting, help you understand things a little bit better in terms of, well, again, how's this going to affect you and I? And the reason I think this is such an important topic, particularly right now, is our federal government just passed a package. They call it a COVID relief package. Let's be honest. Cutting through the noise. Forget the politics. Less than 10% of it went to health-related issues. The rest of it went to a whole bunch of other stuff that had nothing to do with COVID, frankly. And it was the biggest pork in history. Okay? Let's just put it that way. But that's neither here nor there. It's happened. What do we do now? See, the thing is, as I state on every show, just about every show I've been doing lately, because I think this is such an important topic. Look, if you want to talk about money, I'm going to say this. If you're going to talk about money with anyone, a friend, family member, somebody you're discussing, and politics, whatever it is, and it has to do with money, do me a favor. Let's share this thought. Let's have two key thoughts here. One, the first one is people need to understand the government has no money. It's not theirs. They get it from the taxpayers, us, and money that they print, which then makes our dollar less valuable. More dollars, less value equals inflation, right? Things cost more, which affects literally everyone. We all eat, right? We all like to wear clothes. We need someplace. We need a roof over our head. All those things then start costing more. We've seen that currently. We're already seeing it with gas prices. Okay? When the federal government spends money like a drunken sailor, which is what they've done the last year, $6 trillion. And I'm talking about both parties here. Okay? I'm not equal opportunity here. I'm frustrated with everybody, our representatives across the board. When they spend this kind of money, it impacts us. There's going to be consequences. Well, they have to pay some of this back. And I told you, they got two options: print more or tax us more. And President Biden's already come out stated he wants to increase taxes. What do they want to increase taxes on? So some people say they're in the politics of it, they start saying, well, no one's going to get a tax increase if they earn less than $400,000 a year. Now, whether that's an individual or family, who knows, all that kind of stuff. But folks, that is fundamentally not true. Again, forget the politics for a minute. Hold your horses a minute. Here's what I mean. Everybody's going to pay more. Why? When you increase taxes on any level of income earner, and particularly if you're taxing business owners, or talking about increasing the corporate tax rate. Corporations don't pay taxes. They do write checks to the IRS, yes. But where did it come from? They collected it from their customers. And how do they do that? Well, if there's a tax increase, a business is going to do one of two things. It's going to either raise the price of that good or service, so that means you and I pay more for it, or they're going to reduce expenses, which means some people lose jobs or various other things happen. So we will pay for it in one way or another. In increased costs of things. Again, food, clothing, housing, everything you can think of, gas, you name it, all the stuff that we all consume. We will all pay more. So guess what? We're all going to get a tax increase. if we get a corporate tax increase. Everyone will pay more. That's an economic fact. Secondly, what are they talking about raising taxes on? They're talking about doing things like charging a mileage tax. So if you drive too many miles, you got to pay a tax. Well, who does that affect? Everyone that drives a car. Okay. They're talking about a gun tax and a bullet tax. Well, anyone who owns a gun, they're going to get taxed. If you don't, you may think that's all right. If you do, you're probably against it. Okay. What about a carbon tax? They're talking about that too. Well, guess what? Who's that going to affect? Literally everybody. Okay. They're talking about raising capital gains tax, changing the stepped up valuation, going back to the original purchase prices. That's going to affect people when they buy things like a car or a house, or let's say like a house, I should say, for example. Okay, it's going to affect just about everybody. Okay, they're talking about wealth taxes and estate taxes and other various things. Again, the wealthy are not, and again, I work with many of them, okay, quite often. They're just not static entities. Okay, when taxes increase on somebody who's wealthy or owns a business or whatever, and that they don't, you know what, they call people like myself and they say, hey, I'm going to get creamed on taxes. What do? Well, we reallocate. We put things into more tax favorable assets, which, like your personal bank, happens to be one of them. One of the favored ones, by the way, by many of the wealthy. See, here's the thing. If taxes do go up, it's not just how much you pay, but they can also play the percentages. They also can play with the numbers in terms of the brackets, in terms of what the thresholds are. In other words, if you earn more than a certain amount, now you're in this bracket. They can adjust all that stuff pretty much anytime they want. So there's many ways of increasing taxes or increasing the tax burden on literally everyone. So if somebody's in favor of tax increases, just understand you're voting on increasing the cost of living on yourself. Even if you don't get affected directly by a tax where you have to pay it out yourself directly, you're going to pay more for things. So you're going to get impacted also. That's what people need to understand. Okay? So please, if you're sharing this with anyone, help people understand the government has no money. When they spend money, it's ours, okay? It's our money they're spending. And then the thing we should do to resolve this, the solution is simple. We need to demand fiscal responsibility from our elected leaders. Because without it, they're just going to keep spending our money and get rewarded. In other words, if they're not rewarded for it anymore, they'll change their behavior, won't they? We allow them to do it, and I just don't understand that. Congressional approval ratings have been hovering under 20% for well over a decade. Gosh, I think it's been probably the last 20 years plus. In other words, the vast majority of people are not happy with what they're doing, yet we keep re-electing the same folks over and over again, or the same type of folks who go and then just spend our money like a drunken sailor. We need to stop that. We need to wake up and smell the coffee and demand some fiscal responsibility. Stop wasting our money that we work hard for, right? Most people don't realize this. If somebody has some money, most of the time, the vast majority of the time, they just didn't fall into it. They didn't inherit it. They didn't win the lottery. I mean, I've worked with personally over 1,000 clients in my 22 plus year career. Our company has over 5,000 clients. I'm aware of 2 lottery winners that are clients of ours out of over 5,000. 2. Okay? I could almost count maybe on a couple of hands the numbers that inherited a significant amount. Okay? The rest, they did it themselves. They worked hard. They invested. They lived on less than what they earned. They did it the right way. Okay? That's really how wealth is built. And that's why I'm such a fan of your personal bank, because you set money away. Typically how somebody funds it is either they have some assets and they want to reposition those into a option where there's less risk, typically market risk, things like that, risk of loss. They want to go into a more safer, guaranteed type of account. They want access liquidity often. They also want the tax benefits. You want to grow money tax-free? Again, this subject today we're talking about, it's going to be even more important than ever. I think it's pretty darn clear that our taxes are going to go up. So then you need to start asking yourself a question about what are you doing with your money? If you're putting money away for the future, how is that money going to be taxed? Do you have a tax-free bucket, for example? Do you have an option that it doesn't matter which of these taxes they decide to enact, or if they enact all of them? If you're income tax-free, it won't matter. If you're a tax-free account, it won't matter. In fact, there's a book I recommend quite often by David McKnight. It's called The Power of Zero. If you haven't read it, and particularly if you have an IRA or 401k or anything like that, you really need to read this book now more than ever. It's called The Power of Zero by David McKnight. The principle of the book is quite simple, and the statement is simple. It just states, look, if tax rates double in the future, and they could, they've been that higher in the past. If they double in the future, 2 times 0 is still 0, isn't it? In other words, you won't care. Well, you'll care. I still care, because I hate to see people we all end up paying more for things. But at least our money that's growing isn't getting taxed, and we can have access to it. So we can grow our money tax-free with a personal bank. We can access it through the tax-free, and we can pass it on to our heirs income tax-free. Now, again, all this has to be set up properly, which is what we do. We teach people how to do it. More information, contact me at yourpersonalbank.com. Be happy to share with you exactly how it works, give you more information, answer any questions you have, and see if this makes sense for you. But here's the reality. Will a income tax-free bucket of money growing be more valuable with higher future taxes? Yeah, of course it will. And we're also going to talk about in the next segment, I want to talk, if you have an IRA or 401k and you're deferring taxes now at frankly, a historically low tax rate, and there's a strong likelihood they're going to go up in the future, you got to start rethinking that plan. Does it make sense to defer taxes now at a historically low rate to then have to potentially pay it potentially at a higher rate in the future? Stay tuned. I'm going to answer that question in the next segment.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and we're talking about a fun subject today, taxes. Now, before you tune out, I'm going to make it interesting. Really I'm not going to bore you with a bunch of details and numbers. What I'm really wanting to focus on is, well, it seems quite clear. Our president has stated that they want to raise taxes. So it seems quite clear and obvious that tax rates are going to be higher in the future than they are now. Most likely, starting next year, 2022, we'll see an increase in taxes. Now, how is that going to affect us? What should we do? How do we plan for it? What should we do to avoid or lessen the impact? Because here's the thing, when tax rates go up, it doesn't just affect the wealthy. This is another financial literacy thing, I should say. When taxes go up, businesses, wealthy, whatever, reallocate where they're at investing. They go to more tax-free or tax-favorable investments. Businesses, if they get taxed more, they just charge more for their product or service. Okay? They don't pay the tax. The consumer does, you and I. Or they reduce their expenses, which means some people get hurt by losing jobs and various things like that. So everybody's affected. That's the thing people need to understand. And the reason everyone is affected is really quite simple. It's not political. It's real simple. The government has no money. The money they get is from us, the taxpayer, or what they print. Okay? That's a fact we all need to understand. But I want to move on here. How do we respond to this? What do we do? Again, one of the things we got to consider is we are right now, as we speak, in one of the lowest income tax situations in history, like one of the third or fourth lowest since the beginning of the income tax. When I share that and I show the charts with people, many times they're surprised because, the political stuff we hear out there is, tax rates are high and all that. And the reality is, compared to from a historical standpoint, we're in one of the lowest tax situations in our government's history. That's a fact. Okay? Just a fact. Can't argue with it. Now, taxes most likely, based on what they are telling us, will be higher starting next year. If you have an IRA or 401k, 403b, 457 plan, any of these qualified type plans, deferring the tax now and then paying it later might have made sense. May still make some sense. But if tax rates are going to be higher in the future, it starts to make less sense. Here's why. I'm not saying you shouldn't contribute to an IRA or 401k. If you have a company match, that's obviously a benefit. But here's what I am saying. If you're contributing to one, you really need to analyze, are you doing the best thing for you? Are you doing the right thing to minimize your overall tax burden? What do I mean by that? It's really quite simple. If you're deferring taxes now on what I call, here's a question I ask all the time. It's quite simple. If everything is equal, does it make sense to pay tax on the seed or the harvest? See, that's kind of a tough question, but I get a lot of response from that, and I get answers all over the board. See, here's the thing. If you pay tax on the seed, the contribution, okay, typically you're paying tax on a small amount. That's why we call it the seed. To then later, hopefully over time, it grows to a larger amount, which is the harvest, right? So should you pay it going in or should you pay it going out? You're going to pay one way or the other. And that's your traditional IRA versus a Roth, for example, or traditional IRA versus life insurance, cash value life insurance policy, okay? Or an annuity or whatever, okay? Actually, I back up on the annuity part, but cash value life, okay? So here's the thing. Because annuities work much like traditional IRAs from a tax standpoint, all right? Should you pay it now or should you pay it later? See, I can't answer that question right here for you on the radio. It depends on your situation, the amounts we're talking about, and what we think the rates are going to be now versus then. Now, first of all, it's impossible to predict what the rates are going to be in the future. Can you tell me what tax rates will be in 5 or 10, 15, 20, 30 years from now even? And of course, the answer is no. No one knows. Is the likelihood of the taxes being higher greater or less? I'd say it's pretty obvious, much greater now. So if tax rates are going to be higher in the future, and we're going to get a more clear idea on this as things move forward, when we start getting an idea of what the rates are going to be going forward, it's going to start making less sense mathematically to defer the tax now to pay later. In other words, you want to pay it now when it's cheaper, lower, and then defer it, pay it now and then let it grow tax-free. That would be a Roth, for example, or a cash value insurance policy, high cash value policy like we talk about. Okay? So my point is quite simple. You really want to analyze this, and now that things are changing, now's the time to start looking into it because you want to implement it this tax year while you still can to take advantage of the rates while they're still here. Okay? So there's a lot of things that go into it, but I would just encourage you to contact us at yourpersonalbank.com so we can run the numbers. I just tell people, look, they'll ask me the question. My answer is the same. I don't know until we run the numbers. But let's look at your situation, run the numbers, and see what makes sense. Okay? Secondly, does it make sense to create an alternative bucket of money, a tax-free bucket? If you already have a taxable bucket, let's say you have an IRA 401k you've already built over time or whatever, does it make sense to build a tax-free bucket, especially now when it looks like tax rates are going to increase? And the answer is, of course, even more so than before, right? So there's several reasons behind why doing a high cash value policy that can grow income tax free, you can access income tax free, and also pass on to your heirs income tax free. And it's going to be more valuable today than it was before because the change in the rates, most likely, and most likely higher. So you see, my point is, you can be, one of the statements I say to folks all the time is simple. Do you want to be proactive or reactive when it comes to taxes? And the answer is pretty obvious. In other words, if you don't have a plan, do you think the IRS has one for you? And the answer is, of course they do. So you really want to analyze this and look into this. So I can't stress enough. Contact us at yourpersonalbank.com. We'll show you how, well, in many cases, most often, we can reduce the overall tax burden for somebody. And isn't that, it's perfectly legal. It's part of the tax law. We're not playing any games. No sleight of hand. Nothing like that. We're just following the rules, the rules of the game, the rules the way they stand, right? We're just like any, that's wise planning, isn't it? The bottom line is, here's the set of rules. Some of the rules are changing. How should we adjust to those rules? Should we adjust? How much should we adjust? What makes sense? That's all we're doing. So it's not illegal. It's not unethical or anything like that. It's just looking at the rules. My wife says this to me all the time. She says, look, if you want to win the game of life, it's pretty simple. First thing you need to do is understand the rules. The better you understand the rules, the more likely you're going to be able to win, right? It's just that simple. And folks, what I want you to understand is the tax rules, they're changing. Our president is stating he wants to change them significantly. So the rules are going to change significantly. We have to adjust to it. Stay tuned in the next segment. We'll talk about how to do that, so don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. We're talking about taxes today, and I'm trying to make it interesting so it's not too boring, but informative. And here's one of the things is, again, if you believe our current president, that he states he wants to raise taxes, he's even stated he'll ram it through like he did the last thing on a partisan manner if he needs to. So it looks increasingly likely that that'll happen. We'll see. But the point is quite simple. If tax rates are going to go up in the future, then how do we react to that? What do we do to mitigate that, minimize the tax impact for us? Okay, we're at the facts are simple. We're at a historically low income tax situation, one of the lowest in history. That's the facts. Okay, forget the politics. That's just the facts. And if that changes significantly, which it very well might, we need to have a strategy on what to do. How do we react to this? Well, here's a couple of things you can do. First of all, one of my mentors, a tax attorney, he always shares, and I like this. He says, look, the number one best way probably to reduce your taxes is to not have to pay them in the first place. And what he means by that is have deductions, have legitimate deductions to offset so that you don't have to pay tax on it. And some of the best ways to create deductions, legitimate ones, is through owning a business or investing in real estate. So those are a couple of the best ways to increase your deductions, which would reduce your overall tax liability. Now, if that's not something that you're interested or willing to do, there's other ways to address and reduce the overall tax liability. I touched on it in the last segment in terms of qualified plans, tax deferral, things like that. Does it make sense to defer tax if you're contributing to those, for example, IRAs, 401ks, whatever? You've got to ask yourself a simple question, not just do it blindly because everybody else is doing it. That's not a good reason. which is, by the way, the most common reason I get when I ask, why are you doing this? Why do you have this account? Well, because everybody else is. Well, that sounds like a really good reason. It's not, okay? You really need to look at, should you paying taxes on the seed or the harvest? Should you defer the taxes now to pay them later when you take them out in retirement, for example? Or should you pay the tax now on the seed, the smaller amount, ideally, and then let it grow tax-free for the rest of your life and access it tax-free? That's one of the things your personal bank can do. There's other options in that can be done too. Roth IRAs can accomplish that. The problem I have with Roths in particular, though, not that I think in general, when we run the numbers, statistics show that people benefit from paying the taxes on the seed versus the harvest in most cases. And the reason is quite simple, by the way. The reason we get told to defer taxes now to pay them later is we're told we'll be in a lower tax bracket when we retire. The statistics show that's not true, something like over 80% of the time, because things like Social Security income, pension income, or other incomes are become taxable even when you're retired. So frankly, the statistics show most time it doesn't work. But I'm going to give you a bigger reason for not doing that. Look, if you're in a lower tax bracket in retirement than you were when you were working, doesn't that mean you're making less? And the answer is yes. Does that sound like a good goal? Should that be something you're striving for? The answer is absolutely not. Because there's something else. There's an insidious little thing called inflation. Now, with normal levels of inflation, based on the past 100 years, the price of things double roughly every 20 years. So if you retire for 20 years, you're going to be paying roughly twice as much for everything than you were when you started your retirement 20 years later. And if you are on less income to start with, those kinds of things don't add up. And people keep living longer and all those types of things. So frankly, in my opinion, that should not be your goal, to make less. In fact, we as human beings, I'm not here to preach to anybody, but I think most people understand we tend to achieve what we focus on, right? And if you're focusing on, well, my plan is to make less in retirement, be in a lower bracket, you'll probably accomplish it, or more likely to, right? And that's not a good goal. It's just not, okay? So my point is simple, is how do we reduce our overall tax liability? I've already shared a couple thoughts already. And if you've missed them, go to yourpersonalbank.com, go back and listen to this, and I'll encourage you how to do it. Now, I'm going to encourage you lastly to stay tuned to the next segment, the last segment, because what I really want to do is answer some of the questions, how I talk about how your personal bank is one of the unique tools, financial tools out there that allows you to grow money income tax-free, access it income tax-free, and then pass it on to your heirs income tax-free. It's unique in that regard in terms of doing all of that, okay, be able to accomplish all of that. And I get to ask the question all the time, how can that be? How can that be done? Well, stay tuned in the next segment, and I'll share with you exactly how that's done.
For more information on your personal bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. We're rounding third and wrapping this up. I've been talking about taxes today. Why is this so important? Well, it's really quite simple. The Biden administration has been stating repeatedly that they want to raise taxes. They have the majority in the House and the Senate, and they have the presidency. So they clearly have quite a strong ability to be able to do that. If you believe taxes will be higher in the future, which is, again, a very strong possibility, or I'm going to say most likely, then you need to plan for this accordingly. And you want to be proactive rather than reactive. I say this all the time to folks. Look, do you want If you don't have a plan, the IRS has one for you, don't they? So which plan do you want to follow? Typically, which one's better for you? So the thing you need to understand is whenever taxes change, tax rates change, increase, decrease, whatever it is. So we're looking at probably some pretty significant changes and probably some pretty significant increases in many areas of tax. How do we reduce the overall liability? Well, one of the ways to do that is quite simple, is invest in things that are tax favorable. I'm going to talk about this further. In some of the previous segments, I talked about some of the things you can do in terms of reducing your overall tax liability, like owning a business or investing in real estate and things like that. Those things work, but that's not for everyone. I talk a lot about the personal bank concept in terms of being a tool that can grow your money income tax free. You can access it to income tax free. You can pass it on to your heirs income tax free. It's nearly unique in those capabilities. And it really comes down to the point of, should you pay tax on the seed or the harvest? In other words, do you want to pay the tax on a small amount now, let it grow tax free the rest of your life? Or do you want to defer it like through an IRA or 401k if you have that ability, depending on your situation, if it's even available? You want to defer it now, which a lot of people do, to then pay later in the future at an unknown future rate and probably higher rate on a larger amount of money. Typically, the statistics show that works out to the individual paying more tax overall, and many times significantly more tax. So, in other words, who wins, you or the IRS? There's legitimate ways of doing this. One of the things I always tell people, I get asked these questions all the time, tax shelters and offshore kind of things and various things. Those are the kinds of things the IRS really frowns upon. Okay? And so I really discourage people from when they're trying to reduce their tax liability, to avoid those kinds of things. There's legitimate ways of reducing your income tax liability, or overall tax liability, I should say, that are a part of the rules. And the key is just understanding the rules and knowing how to play by the rules. And I get asked quite often, when you say, if you set it up properly, the personal bank can grow, access, and pass on monies tax-free. How can it do that? Well, it's really quite simple. I'm going to explain exactly how that works. See, again, what we do, the personal bank concept is really quite simple. It's not complicated. Some people try to make it out to be more complicated than it really is, but it's really common sense. It's simple, it makes sense, and it works. And it's worked for decades and decades. Gosh, I've stated some of these companies have paid dividends out consistently, literally since before the Civil War. So that's how long it's been working, okay? That's an incredible track record. Never miss a dividend, even through the Great Depression. That's impressive. My point is simple. We set up a high cash value policy. This is not the type of insurance policy most people are familiar with. That's the key thing to get over. If there's a hiccup or a hang up or a stumbling block, I should say, for anyone, this is it. I'm going to tell you right now. They have in their mind what insurance is, and it's in a box, and the box is insurance is death benefit protection only. And the reality is, yes, it does do that if you set it up for that. But the key is you want to think of a teeter-totter. We don't focus on that, typically. Look, if you have death benefit protection needs, sure, it can help you get the best rate, best quotes, whatever. That's simple. You can go online and do that. That's not what I'm talking about here. See how most insurance policies are set up. And again, if you can picture a teeter-totter for a minute, you have cash value on one side, death benefit on the other, on the teeter-totter. And again, most insurance is set up where you want to pay the least amount of premium for the biggest death benefit, right? That's a death benefit protection policy. There's little or no cash involved. There may be some, but it's not the main purpose. The main purpose is for death benefit protection. Look, if you have those needs, as I do, I have a family, a business, have some of that. Have what you need to protect you and take care of your loved ones. But what we do is our focus is primarily to grow cash. We want to maximize dividends. And I've stated that we have companies that have been paying 6% dividends plus this year still, and every year for the last 25 plus years, and never missed a dividend since before the Civil War, literally. So it's about growing your money, gaining dividends, maximizing the growth consistently. They have underlying guarantees with these companies. They've never paid less, like I said, than 6% over the last 25 years. You have with underlying guarantees, it's consistent, it's steady, it just grows every year. We have an index option based on the S&P 500. If you want higher potential growth, I'll show you both options. But the one that's most popular, I can tell you by far, when I show both options and actually lay out the numbers for somebody, most people, 9 times out of 10, frankly, choose the Steady Eddie option. I share both. I'm agnostic. I don't care which way you go. That's a problem in our industry. So many agents will love one and hate the other. My point is there's a place for both. And depending on your situation, maybe we do some of both, by the way. So you don't have to choose the Steady Eddie versus the index. Why not do some of both if that makes sense for you? But my point is our goal is to grow cash. I don't want to get away from the main point here. Think of the teeter-totter again. We flip the teeter-totters, completely the opposite to what most people think about when they think of insurance. We want to maximize cash growth and minimize the death benefit. Now, there's quite a range of what can be done in that, and that's even expanded further just this past year through a recent tax law change, which is awesome. Now, somebody can even grow more cash in a policy than they could last year or any year in the last 40 years, by the way. By the way, if you have one of these because of that tax law change that took effect end of 2020, I highly encourage you to contact me at yourpersonalbank.com. Let's compare the numbers because the new numbers are better than last year's or any of the last 40 years, literally, because of this tax law change. So I encourage you to contact me. We can show you a head-to-head comparison, show you more cash than you're earning now if you already have one of these. But here's my point. We're setting this up to maximize cash growth, maximize dividends. That's pretty straightforward. Most people understand that now. Okay, I'm going to put some money in here. I want it to grow. I've got some guarantees. It's going to grow income tax-free. Deferred, actually, technically, the term is it grows income tax deferred. In other words, in the policy, it's going to grow if you don't touch it, okay? Just like an IRA does, for example. You don't touch it, or an annuity. You don't touch it, you don't get any tax, no taxable event. Now, the second step is we set up a bank line of credit. The cash in the policy is collateral for the loan. The bank will loan up to 95% of the cash value in the policy. Therefore, the vast majority of the funds are available to you, and here's the benefit. Here's the positive arbitrage. If you're getting 6% dividends, and the bank's charging you between 3 and 3.95% interest, that's the current rates. When you access the funds, what's your money doing? Still growing. You're getting the difference. I tell people, look, you're going to pick up 2-3% positive arbitrage. And by the way, that is historical. I've got charts from showing you. One of the companies has shared with me the dividend rate they're paying and the interest rate they're charged. There's a positive arbitrage every single month for the past 40 years, except for 2 months. And those 2 months, the rates were the same. So that includes low interest rate environment, average interest rate environment, and high interest rate environment, because it's all interest rate sensitive. In other words, I stated earlier, I think in this show, or maybe the last one, that prior to 08-09, pretty much all these companies were paying 7-8% or better dividends. Now they're paying like 6% because of the low interest rate environment. Well, when interest rates climb, when the banks start charging more interest, what's going to happen? The dividends will be higher. That's what's always happened historically. So I can't guarantee you'll have a positive arbitrage, but over the last 40 years, you have for every month except for 2, and they were the same. So you see my point. My point is we're growing dividends, we're maximizing dividend growth, minimizing the death benefit. We're maximizing the dividend growth. So we leave it there, it's just going to earn its dividends. It's just going to grow like any other account. There's not going to be any tax because it's tax deferred. You didn't touch it. Now you access it from the bank line of credit, and they're charging you less interest than you're earning dividends. You keep the difference, the 2 to 3% positive arbitrage. Now, I'd be remiss if I didn't remind you, here's one huge, huge key. This is the key to all of it. If you understand this point, you get the whole thing. And here's the point. That 2 to 3% positive arbitrage you're earning, the difference of the dividends minus the interest you're getting charged, is on money you spent. When the light bulb comes on for folks, they understand, holy cow, I can make money. I can still earn some interest on money I spent. And the answer is yes. Show me another way of doing that. I'm open to it. Contact me at yourpersonalbank.com. Share with me how you can make 2 or 3% positive arbitrage with guarantees, with tax and being income and tax free. Show me how you can do that. Here you do. Now, how is it tax free? You access the money. Normally, when you access money from a tax deferred account, right? There's a taxable event. Well, there's a couple of different ways. If you take it through a policy loan directly from the policy, and it's structured properly, that's where we get into the MEC rules and things like that. Those are considered advances on your death benefit and therefore not taxable. But there's a better way. When you access the funds through the bank line, as I stated earlier, you're not only getting the positive arbitrage, you're keeping the difference of the dividends you're earning with the policy and the interest rate the bank's charging you. So you're keeping that 2-3% difference, right? But when you get it's a bank loan. When you take a loan from a bank, is that taxable? Is that considered income? And the answer is no. It's loan proceeds, not income. Perfect example. Have you ever taken a cash out refi or money from a home equity line of credit, for example? When you receive those funds, did you get a 1099? Did you get taxed from the bank? Did you get a 1099 from the bank and were you taxed? And the answer is no. It was loan proceeds. That's why it's not taxable. Now, the next question I get all the time is, well, if I access funds from the bank, I take a loan, I'm going to get charged interest. I don't want a debt. I don't want get charged interest. Well, here's the thing. If you're getting charged 3% interest, for example, but you're still earning the 6% dividends, aren't you still making money? You see my point. If you're earning more than you're getting charged, the amount of money you have increases each and every year. That's the beauty of this. That's the power of your personal bank. By combining the high cash value policy to earn dividends, to maximize dividends, and then access through the bank line at a lower rate and keeping the difference, making the difference. So you're actually, yes, you get charged interest, but you're making more than you're getting charged. You keep the difference. That's called positive arbitrage. Contact me at Your Personal Bank for more information. I'll be happy to clarify any questions you have, share more information with you, and show you how you can take control of your money, enhance your financial future. And as long as it's still on our money, I'm going to say this: in God we trust.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.